The year is 2025 and the stock market is a wild ride. Inflation is still a concern, interest rates are bouncing around like a kangaroo on a trampoline, and geopolitical events keep throwing curveballs. It's enough to make even the most seasoned investor break a sweat. But fear not, knowledge is power, and understanding these global economic shifts is the first step to protecting and growing your hard-earned money. First up, inflation. It's still a factor, folks. When prices rise, companies face higher costs, and that can eat into their profits. Keep an eye on inflation reports and watch how central banks respond with interest rate hikes. Higher interest rates can slow down inflation, but they can also make it more expensive for companies to borrow money, which can stifle growth. Next, we've got those pesky geopolitical events. From trade wars to political instability, these events can create uncertainty in the market, leading to volatility. Remember, the stock market hates uncertainty. Stay informed about global events and consider their potential impact on your investments. Finally, let's not forget about those interest rate hikes we talked about earlier. When interest rates rise, it can impact company profits and make bonds more attractive to investors. This can sometimes lead to a shift of money out of the stock market and into bonds. Keep an eye on the Federal Reserve's announcements and be prepared for potential market fluctuations. So how do you navigate this crazy market, you ask? 2 words, diversification and risk management. Think of diversification like this. Don't put all your eggs in one basket. Instead, spread your investments across different asset classes such as stocks, bonds, and real estate. This way, if one area of the market takes a hit, your entire portfolio won't go down with it. Within each asset class, you'll want to diversify even further. Don't just invest in 1 or 2 companies, spread your bets across different sectors and industries. That way, if one company or sector underperforms, it won't drag down your entire portfolio. Now let's talk about risk management. This is all about understanding how much risk you're comfortable taking with your investments and making sure your portfolio aligns with your risk tolerance. If you're young and have a long time horizon, you might be comfortable taking on more risk for the potential of higher returns. But if you're closer to retirement, you may prefer a more conservative approach. One way to manage risk is to set stop-loss orders. This is an order you place with your broker to automatically sell a stock when it reaches a certain price. This can help limit your losses if a stock starts to tank. Now that we've covered the basics of navigating a volatile market, let's talk about some exciting investment opportunities on the horizon. Emerging sectors like artificial intelligence, renewable energy, and tech are poised for significant growth in the coming years. AI is revolutionizing industries from healthcare to finance, and companies at the forefront of this technological revolution are well positioned for success. Think about investing in companies that are developing AI-powered solutions, as they are likely to see significant growth in the years to come. Renewable energy is another sector with massive growth potential as the world transitions towards a more sustainable future. Solar, wind, and other renewable energy sources are becoming increasingly cost-competitive with fossil fuels, making them a smart investment for the long term. And of course, we can't forget about tech. The tech sector is constantly evolving, with new innovations emerging all the time. Keep an eye on trends like cloud computing, cybersecurity, and the metaverse, as these areas are likely to drive growth in the tech sector for years to come. When it comes to investing, time horizon matters. Short-term investing is all about trying to make a quick buck by timing the market and taking advantage of short-term price fluctuations. It's a high-risk, high-reward strategy that's best suited for experienced investors who can handle the volatility. Long-term investing, on the other hand, is about the power of compounding. By investing consistently over time and letting your investments grow, you can build wealth slowly but surely. This approach is less risky than short-term investing, and is ideal for those who are saving for retirement or other long-term goals. So, which approach is right for you? It depends on your individual circumstances, risk tolerance, and financial goals. If you're unsure which path to take, it's always a good idea to consult with a financial advisor who can help you create a personalized investment plan.